Hello and welcome to this Forex Preview at xm.com. I'm Maria Pachurdes, and joining me is investment analyst Christina Parthenidou. We'll be discussing the Bank of England's upcoming meeting on Thursday and the potential reaction in the pound. So Christina, the Brexit headache has resurfaced after the summer break, reminding markets that COVID-19 is not the only downside risk to the economy. Do you think the Bank of England will signal a shift in policy at this time?
Hi, Maria. Well, besides Brexit, we didn't have negative surprises in key economic indicators lately. On Tuesday, the employment report for August showed a very small decline compared to what markets expected to see, and the unemployment rate didn't increase further and is still one of the lowest in Europe, suggesting that the stimulus programs from the government and the central bank are working for now. Moreover, the rebound in the PMI business readings, which returned to growth, was impressive in August, and retail sales turned positive on a yearly basis as well, indicating that household spending is also moving in the right direction because of the reopening plans and the financial aid. However, as you have mentioned before, the virus story is not over yet and remains a major risk because no one can really predict if a vaccine will be approved by the year end, and if this is the case, if it will be available for use this year. So restrictions could remain in place at the start of the next year, and without the furlough employment scheme that expires next month, the unemployment rate could turn a double-digit number. So definitely more is needed to be done to support the economy, especially if the UK and the EU fail to secure a trade agreement before the transition period ends in December. That may strongly disturb trade activities because the UK won't be treated as a European member anymore next year. But currently, it's not clear yet how the Brexit trade talks will evolve. Perhaps the initial approval of the internal market bill by the parliament, which violates the withdrawal agreement on Monday, is just part of Boris' political strategy to pressure the EU and get the agreement he desires. So for now, the bank may likely prefer to adopt a wait-and-see approach, but it will likely provide some information about what else it can do to stimulate the economy, since it has only 2 meetings left in the agenda, and November could be the best time to do it. So that is what traders will be looking forward to hear on Thursday.
Okay, so if the Bank of England were to choose between negative rates or another round of quantitative easing to prop up the economy in the near future, what do you think it would be more likely to pick?
Well, in the previous policy meeting, the bank said that negative rates are still in the toolbox but are not an option yet. And it seems that policymakers are not very willing to drive rates below zero unless conditions sharply deteriorate. Besides, such a move would also pressure bond yields to the negative area and further delay the timing for a rate hike, which would consequently discourage investment, and that could be harmful, especially for a country such as the UK, which is highly dependent on deposit funding. So another round of QE and likely a stronger forward guidance could be a more possible scenario, which may probably take place as soon as in November.
And finally, regarding the pound, what should we expect?
That may depend on how dovish the Bank of England may sound and whether it will signal a more accommodative policy in November. For example, if the bank appears more optimistic about a V-shaped recovery and gives less weight on the Brexit uncertainty, saying that it will do whatever it can do to further boost the economy, including a potential increase in asset purchases, then the pound may extend its recent rebound against the dollar. Otherwise, if it sounds more cautious about the economic outlook and appears more worried about the Brexit risks, then the currency may probably drift lower.
Christina, thanks so much. And thanks for joining us at xm.com.